I'm Peter White. Welcome to the Inside Network. Welcome to INDepth. I'm Peter White, and my guest today is Alex Lennard from Ruffer Investment Management. Alex, welcome.
Thank you for having me.
Now, Ruffer has quite a unique approach to investment. Could you talk us through the whole Ruffer style and the Ruffer ethos in investing?
Absolutely. So when Jonathan Ruffer founded this business in 1994, he had a very simple principle that grounded everything that we did. And that was, as much as clients like making money, they hate losing it more. So our starting point really does come from looking through the other end of the telescope, which is first and foremost, we ask ourselves, what are the risks in the world and how can we avoid losing money from those risks and protect our clients from them? But then doing that with a portfolio that's fully invested, because to use an analogy from an economist, yes, there would be fewer car accidents if people drove around with a spike on their steering wheel, but then they wouldn't make very much money and go anywhere very quickly. So from our side of things, it's about being fully invested in risk assets, but doing it in a way that provides a degree of certainty, and particularly certainty during periods of stress. And we think if we can do that, that should enable us to make very good returns when times are good.
Well, can you expand on your portfolio construction process, the investments within the Ruffer universe?
So reversing the question, the investments within our universe can be anything and everything. So we are global, we are multi-asset, and we are unconstrained both at asset allocation and security selection level. So it is really a go anywhere strategy. In terms of our process, because our focus is on avoiding drawdowns and making positive headway in all market conditions, our starting point is first and foremost, identify the risks that we see in the world. Obviously asking ourselves, how likely is it that those risks are going to come to pass and how impactful are they? If the answer to both of those questions is yes and somewhat, we'll put in place the assets that we think will make a positive return and help drive overall positive outcomes should those risks happen. But then because we have this privilege of being multi-asset and being unconstrained, we always ask ourselves, what if we're wrong? What if we're wrong to worry about the risks? Do we have enough assets in our portfolio and enough differentiated assets in our portfolio that will enable us to grow our portfolios should the risks not come to pass? Now, clearly, in an ideal world, we would switch from our growth to protection at the top of the market and vice versa at the bottom. But the reality is we don't have that perfect foresight. So we're always going to have some growth and some protection in portfolios at all times, always asking ourselves, what if we're wrong? So in contrast to most people in the industry, we're not trying to be absolutely right, but instead trying to avoid being absolutely wrong.
Well, you're a multi-asset strategy manager, you say. Let's talk recent history. How has the portfolio or the underlying portfolio evolved, say, since 2019?
So if I take a step back, I think the real strength about what we do at Ruffer is identifying regime change and identifying the assets to benefit from moments of regime change, but then constructing a portfolio around those such that we can carry them positively in the interim. Going into 2019, we had two central observations. The first was that markets were avalanche prone, so unable to withstand a shock. And the protections that we had against that were things like call options on the VIX, so assets that benefited from rising volatility, but also combining that with the assets that we felt that we would need for the end game. So our second observation was that faced with a deflationary crisis, the authorities would bring to bear a huge response, both monetary and fiscal. So interest rates and quantitative easing, plus direct government spending. That we felt would ultimately catalyze us into a new investment regime characterized by higher uncertainty and higher inflation. And to protect against that, we have significant allocations to inflation-linked government bonds and gold. So those were our core protections back in 2019, and the growth assets in the portfolio were principally equities. How that's evolved over the course of time is the call options on the VIX absolutely saved our bacon in March 2020 and enabled us to make a positive return. That enabled us to redeploy capital into dislocating markets, which is something that we've done multiple times in our history, dating back to the dot-com bust and the global financial crisis. Is if you can preserve capital in periods of stress, there are huge opportunities to take advantage of. Now, if I look at our portfolios today, we still have the key anchors of equities to capture nominal GDP growth and the good times. We have significant allocations to inflation-linked government bonds because we do feel that we are heading to a structurally higher inflation regime, and they are one of the few assets that can protect against that environment. But the protection has evolved slightly. So we have moved away from protection against equity markets and rising volatility to owning things that benefit from rising interest rates. So options that benefit from higher yields, and credit default swaps that benefit from higher credit spreads. So think greater term premium in financial markets more generally.
Well, talking about inflation, I think everybody understands it's on the horizon or is here already. Is your house view that it's going to be a bubble or a blip, or is it set in for long term?
So the question is essentially, is the inflation we're seeing at the moment transitory or more structural in nature? Rather unhelpfully, my answer is probably both. Taking the structural side, we think the economy, particularly a number of the one-off trends that have driven the disinflation of the last 4 decades, are going into reverse or can't be repeated. So China is no longer going to be exporting deflation to the rest of the world. And we're generally going to go from being peak globalization to a slightly more disrupted supply chain. So all of the structural pressures, and you can add demographics to that, are potentially going into reverse to generate a more structurally higher inflation regime. Why I say both is right here and right now, when inflation is measuring pretty high, we do think that that does roll off as we go through the northern hemisphere summer or the southern hemisphere winter. The supply chain bottlenecks are going to ease. And just a simple mathematics of looking back to where we were 12 months ago, the inflation readings are probably going to come down in the short term. The challenge will be, if that does start to be appearing quite disinflationary in nature, what will be the government response? And we think it will probably be quite aggressive in nature. So if you think the management of the economy has transitioned from economists and central bankers towards governments and politicians, who by their nature are likely to be amplifiers rather than acting as a suspension on the global economy. So our headline is, we're going into a world of much higher inflation uncertainty, and that is going to lead to a much higher structurally inflationary regime.
And where does the geopolitical situation fit in terms of inflation? Is that one of the key issues you've got to deal with, but the instability about China, Russia, is that in the same level of magnitude, or is that a secondary issue for you guys?
I think it's one of the really important inputs. And if you look back to the previous regime, which is essentially the regime that we've all operated in through our financial careers, was one characterized by more global coordination. So you had the breakup of the Soviet Union, you had China joining the World Trade Organization and the global economy. All of that embedded disinflationary pressure in the world. So now that we are moving from one where you're probably getting greater disorder on a global political level, that's there's likely to have the opposite effect. So if you think globalization was disinflationary in nature, the fact that we've probably seen peak globalization is likely to be more inflationary in nature. And you can just see it in the very short term with the tension you're seeing in the Russia and Ukraine, the impact it's having on oil prices, which were already starting to move upwards.
Do difficult times like we're experiencing at the moment, do they favour your management style? Do you think, is it easier for you to sell your story and or to manage your portfolio when things are unstable and insecure?
Generally, what we find is, I mentioned earlier, the idea of owning assets to protect against periods of regime shift. Generally, that is characterized by periods of disorder. So as we're experiencing that regime shift at the moment, that does play into our way of thinking. I would say, looking at the last 4 decades, this is a world that's really benefited portfolio optimization. So people trying to run as fast as they can and seeing risk management as a secondary process. So coming as an afterthought, I think that introduces fundamental vulnerabilities into portfolios. Because we look at things through the other end of the telescope and put the risk management and avoiding losses at the start, we think that puts us in the right mindset to protect against a world where we think resilience is going to be more important than optimization.
You've mentioned regime change several times. When you use that phrase, are you talking literally about change in governments and change in administrations, or are you talking about a change in the investment market structure?
So rather obliquely both, but if I characterize this in the prism of money, money can only really find itself way to 4 places in an economy. It can go to management of companies, shareholders of companies, governments, or workers. The last 4 decades, basically all of the value created in the world has accrued to the shareholders and management of companies. And that's creating a huge amount of dissatisfaction in the world. You can see it in the income disparities. We think this new regime is going to see the pendulum swing the other way. So much more money accruing to governments and workers. And if you think the last regime has been so beneficial to equity markets, a swing of the pendulum back to the other way, where you're going to have much more power to workers and governments, has to warrant some caution to equity holders and asset holders more generally.
Well, what are the consequences of that change, if it does happen or is occurring, for how you select assets to invest in?
For us, it's looking for the causes. So what are the things that potentially cause that, which is why we worry a lot about inflation, but then also having an ability to dynamically manage and change the risk in the portfolios. The key for us is that any strategy held passively is likely to have failure at some point in its future. So you're going to need to have both a dynamic approach to asset allocation, but also the securities you select within that asset allocation.
Well, in terms of physical assets, actual investments, how does this view translate? Does it mean more gold, more equities, more bonds, more crypto, money under the bed? How does it relate? I mean, it's a trite question, but it's one I think a lot of people will be interested in.
For our portfolios at the moment, it does mean assets that benefit from the cause. So the inflation-linked bonds that I referred to and gold within the portfolios. What I'm also talking about here is just a much more volatile macro regime. So assets that directly benefit from volatility. So options on interest rates, credit default swaps. I think the one thing that is potentially controversial will be a willingness to use cash. So cash is uniquely bad in an inflationary environment, but because the damage that inflation can do to both valuations and fixed income markets, it might be a really useful and powerful arrow to have within one's quiver, because it enables you to take advantage of opportunities when markets dislocate.
For decades now, the 40-60 traditional portfolio mix has been a basic of your universe. Where do you see that now, given the periods of low inflation, now inflation coming on? Is that still relevant, or do you have a different story to tell or argument to make when you're talking to clients?
So the 40-60 portfolio, I think, is uniquely dangerous for the world that we're moving into. It's been hugely successful for pretty much everyone operating in financial services at the moment, because bonds and equities have been negatively correlated during times of stress, and both have been rising. So you've had positive carry and protection from that 60-40 portfolio. So owning them both passively has been a fantastic way to generate returns. Now, I think to us, it feels like the bond element has gone from being a help to being a genuine hindrance to the portfolio. So instead of being risk-free return, it's now return-free risk. And the key question is what happens to equity valuations if bond yields are rising? And our general view is that the most crowded areas of markets are probably the most vulnerable to higher bond yields. So we're moving into a world where you're going to see higher inflation volatility. That probably means there's greater interest rate volatility. And this is at a time that both bond markets and equity markets are probably intolerant of that volatility, at a time that investors have really optimized their portfolios around that 40-60 structure that's been so popular for the last 4 decades.
Do you ever make the arguments that your portfolio construction could actually take the whole position of the bond element, given your approach to risk and your aversion to risk and your desire to work against drawdowns?
Certainly a number of our clients are starting to position us in that sense, in that we hopefully can provide the same certainty that the bond element has provided for the last few decades. But I would say in contrast, and to be slightly technical about it, that we think we've probably got a slightly more positive skew. So a lot of people are moving up the risk spectrum, so out of government bonds and into credit. I think if you're buying credit today, you know what your maximum return is going to be, and any surprise is likely to be towards the downside. We have to acknowledge that we can't deliver a guaranteed return, but because of our focus on capital preservation, that's enabled us to make 9% per annum after all fees and charges over the last quarter of a century. If we can do that and avoid drawdowns and hopefully have positive surprises, that should be something that is a really good protective thing to have in portfolios. And certainly we know a number of endowments and wealth portfolios that are seeing us give a much larger allocation from their defensive portfolio.
When you talk about that 9%, does that set some lights flashing and interest increasing? When 9% for a quarter of a century, it's reasonably impressive, isn't it?
We like to think we've done our job over a quarter of a century, and we think it's a good outcome for clients. I think we have to acknowledge we're in a lower return environment going forward, but if we could generate 6 to 8% per annum over the next 5-10 years, I think our clients will be really happy, especially if we can exceed what the return is on inflation as well.
Alex, thanks for talking to us today.
Thank you very much for having me.